series that showcases the research that is across this Centre for Future Enterprise. Particularly if this is the first time that you've joined in, we extend a special welcome. We also acknowledge the traditional owners of the lands on which we're meeting today, of the various lands, I think, around our spaces, and the important role that Aboriginal and Torres Strait Islander people play within the QUT community. So without further ado, I will welcome Dr. Craig Furneaux. And Craig, of course, is a senior lecturer at ACPNS, and I also work at ACPNS and have had the privilege of working with Craig for a long period of time. Craig's also the subject area coordinator for the courses that are run by the Centre for Philanthropy and Non-Profit Studies, and brings 30 years experience working with non-profits, particularly researching them and working at looking at how they can be more innovative as organisations. His research interests are particularly focused upon resources, including various types of capital, the routines and capabilities, the results, the social impact of non-profits and social enterprises. He also has an interest that he's developing in faith-based charities in civil society. Of course, in the non-profit sector, that's about a quarter of the population. And also Craig serves as the area editor for our most prestigious journal in our sphere, which is the Non-Profit and Voluntary Sector Quarterly. So Craig, I'll hand over to you to talk to us about Goldilocks and financial reserves for non-profit organisations.
Thanks very much, Wendy. And I did too want to acknowledge the traditional owners of the lands on which we live and work, and recognise that these have always been places of teaching, research and learning, and want to acknowledge the important role Aboriginal and Torres Strait Islander people play within the community right across Australia. So greetings, welcome everybody. And so I'm going to go for about 40 minutes and there'll be time for interaction that I'm building into the discussion today. And then we'll have a pause towards the end for any questions. Now, this is pitched because we have a number of charities joining us today, and this is going to go up as a resource for charities. So if you're interested in the academic paper, I'm happy to share that with you and talk through stats and so on. But we've got a more of a practical angle on how we're presenting this today. So in terms of what we're trying to do, we're looking at sort of what are reserves and why do we need them for charities? What are the different types of reserves? So the idea of restricted or unrestricted, those which you can do what you like with and those which you probably can't. And how much of a financial reserve do you need and how to create a reserves policy. So I know there's been a number of charities that have approached me and hopefully this will help. And we're also preparing a short 2-page handout to go with this session that you'll be able to take to your boards once that's finished. So Wendy's already already introduced me. So I'm just going to keep rocking and rolling. So first of all, what is a reserve? And one of the interesting things is that it has a couple of different meanings depending upon who you talk to. So if you go and you look at the ACNC website, the Australian Charities and Non-Profits Commission, it's a fund that a charity sets aside to cover unexpected or sudden costs, often referred to as a rainy day or financial cushion. So this is, your 1 in 100 year event. It's some major thing like COVID, and that is true. There's a type of reserve. But when you go to the taxation office, they have this idea about what's called a restricted reserve. So an organisation may accumulate funds provided that these are applied to the purpose for which the organisation was established. So if you like, the first one's a fairly narrow definition, and the tax office has got a broader definition. But it also has a bit of a sting in the tail, because the idea here is you must use your funds for your mission in order to retain your charity status. And there are links in the slides and in the handouts, and I really encourage you to go and look at these resources. So by way of a segue, and I do really want to try and encourage audience participation, even in this COVID stage. So here we go. And these anecdotes may or may not resemble real organizations, or you may be able to relate to them yourselves, but here we go. So the founder of a charity is at a board meeting and asks what the current bank balance is. And the treasurer tells them the current bank balance is $200,000. Next week, the founder tells the treasurer they've signed the contract for the purchase of a new building worth $1 million, with $190,000 needed as a deposit within the next 14 days. Now, what might be right or wrong with this scenario, apart from the fact of one person getting into that sort of debt? What do you think? What might be wrong with this scenario? What's not being taken into account? This will fail without participation. Anyone have a stab at what might be wrong with that scenario?
That perhaps the funds has been allocated for something else already.
Just because it's in your bank account doesn't mean it's already spoken for. Yep, yeah, right. Anybody else? Thank you, Natalia. Always good to have an accountant in the room. Oh, okay. Well, so that's a really good reason. So the issue is, just because you've got money in your bank doesn't mean that there aren't a series of things for which you need to allocate. So you need to prepare for different things. And when we think about why we keep reserves, basically it's important to, there are really a range of reasons. In the charity space, sometimes funds are given under a trust. They're given via a will as a bequest. And sometimes those funds can be quarantined. In other words, there's a legal obligation to use the funds for which the person in the will has specified. In the third sector, this is called the dead hand from the grave, the idea that there's this dead hand sneaking out from the grave and into boardrooms and controlling what is or isn't done with the funds. So this is something quirky about the third sector. And there is this idea that that's a form of restricted funds. And I'll go into restricted funds in a bit more detail a bit later on. But sometimes if you have grants from government, if you have specific major appeals, you may want to try and quarantine those funds. Another reason is to try and demonstrate financial prudence and stewardship. So saving for the future, perhaps try a pilot program to demonstrate that something works, that you then go for future funding with an organization, to plan for equipment upgrades, to position yourself for a growth opportunity. These are all financial stewardship reasons. To improve financial stability. So cash flows can come and go, and trying to increase your borrowing capacity, trying to take care of interest, or if you're operating overseas, currency fluctuations, it can improve your financial stability. To prepare for the unexpected. 2020 was one big unexpected, but even that aside, what we would call a 1 in 100 year event, there is income fluctuations. We can have disasters. There can be legal costs. There can be unexpected expenditures, staff being ill, a surge in demand for services, a loss of contract, a whole range of things where it might be prudent to set aside some money. And also, this money doesn't just sit there. You can also use it to generate cash. So just for those of you who aren't familiar with the third sector, I did want to just sort of segue a little bit and talk about where this positions itself, because when you have a for-profit, you can always generate income through sale of equity. So you can sell off shares in your firm. And that's not possible for a non-profit. There are no shares. And there are various definitions. This is one that has a European slant to it, but it still works for Australia. That the idea is there are different sectors of the economy, or where people work. So you have government would be considered the first sector. The second sector would be traditionally what's known as the for-profit sector. And the fourth sector is what's known as households. And in the middle of that is really the non-profit organizations. And as you note, there are dotted lines and it kind of bleeds everywhere. And one of the interesting things that's happening in our area of work is that the lines are quite blurry now. So you have cooperatives and mutuals that sort of moves over into more of a corporation, but you also have social enterprises and social ventures that moves more into the corporate space. You've got government that is increasingly partnering and working with and delegating a responsibility to charities. And you have activity without pay, so all the volunteering that goes on in society, which is very significant, but that doesn't include the voluntary work that's done at home. Although charities can volunteer and do work in other people's homes. So it's a very complex area. It has, the third sector has got more employees than, say, retail, about 11% of the income, according to 11% of employees, not including volunteers, as the ABS would tell us. So big sector. Anyway, back to our program. So second question for you. Can you keep reserves legally? So Kylie is the CEO of ACME Association, and she was talking to a potential donor about making a gift. Kylie said, "Have you had a chance to read the reports I gave you? Do you have any questions?" And Stuart comes back, a potential donor, and says, "Yes, I see you have a large amount of money of reserves in your financial statement. I thought you had to spend all of your income for a charitable cause because you're not for profit. You don't make a profit. You don't make a bank surplus. Why do you have these reserves?" How do you think you could respond to that? I'm just noticing some chats going on. Oh yeah, Ruth's saying we need money for a rainy day. Sorry, I was just picking up on the chat. And Yvette, I'll come back to you as well. Yeah, so money for a rainy day. We're going to have to go into a bit more detail on that, and actually we really need to provide some detail in case we're ever questioned. And I've heard examples of large funding, such as government, not funding charities because they have really, really large reserves. So it's a non-trivial matter. So Yvette's saying we're prudent and ensuring that our retained earnings are built up to a level that would cover unexpected events. Yes, so what we have to develop actually to answer these sorts of questions is basically a reserves policy. And we're going to talk about how we get to that a bit later. But increasingly our financials are being put under scrutiny, and increasingly people are asking questions and becoming more financially literate about, well, why do you have such reserves? And looking at our operating costs and our expenses and not giving because of these reasons. Stuff coming up for long service leave. Yes, it's really important to put aside operational expenditures that we know are coming up. Yvette, yeah, the liabilities to funding bodies. Yeah, so one of the interesting things with charity funds is even if you have money from government, if you don't deliver the outcomes, you have to give it back. So you're quite correct. You have to create a liability as well as an asset. So sometimes it's a fictional aspect, and that can be a challenge. So when we talk about reserves, we tend to talk about net current assets. Long service leave. We're investing in research shortly. Yes, that's a very important thing to do, isn't it, Ruth? And a timing issue. It won't be all that large all the time. So sometimes we're saving up for a new computer system or a new building or a new pilot program. And so it has a function that relates to mission and it's going to cease. And to ensure financial stability in the organisation is able to meet its debts as they fall due. Reserves assist with this, absolutely. So there is the idea of a going concern, and if you can't meet your debts, then you're not a going concern, and yes, your board becomes liable. So it's really important to have reserves to save up for a rainy day, but also to look for contingencies, unexpected events, and to ensure that you're a going concern. Very good answers. So one of the interesting things, and if you have a spare day or afternoon, I do encourage you to read the tax ruling. Tax ruling 2015/1, and it goes into a lot of detail about charities and whether or not they can keep reserves. So having too high a reserve basically can be viewed negatively unless you can really justify it. So in order to retain tax exemption, according to this tax ruling, you need to apply your income and assets for mission. So you must actually, so this is what's called the income and assets condition, and for its charitable purpose in accordance with the substantive rules. So it's the governing rules condition. So hopefully your governing document allows you to invest and so on. But this kicker that you must use your income to meet your mission. And on the surface of that, that would suggest you couldn't go into reserves. So what this tax ruling does is it gives a whole lot of examples and situations in which it is appropriate or inappropriate to keep reserves. So to satisfy the income and assets condition, an entity that accumulates most of its income over a year will need to show on a year-by-year basis that the accumulation is consistent with the purpose for which the entity was established. In other words, if you've got reserves set aside, you need to be able to explain and justify why you've done so. So yes, we know we need them, but we actually need to have a policy in place, and we need to have documents about why those reserves are there and what they are for. And we're going to step through that particularly towards the end of the session today. And this is non-trivial because it could technically affect your ability to remain tax deductible and not pay income tax. So what are the different types of reserves? And we've talked about a couple on the way through. So if you like, there are two different ways of thinking about this. There's what I guess I've called the functional approach. So a cash reserve is an operational reserve to cover fluctuations in income. And that's often, that's the ACNC type definition. Together with the second one, which is emergency reserves. So to prepare for existential, so like a market shock. So COVID is a 1 in 100 year event. We've not seen anything like that since a flu back in the early 1900s. But I think it's had an even wider effect in terms of a global impact. So, but it can also have a strategic impact. So sometimes if you have reserves and there's an opportunity, such as a merger or an acquisition, if you have reserves, then it's possible then to act quickly than if you don't have reserves. Endowments we've already touched upon. So funds that are gift, borrow, will, such as bequest, can provide interest. And the reason why we have to quarantine them is it may be that you can never spend the capital. The capital has to be kept in perpetuity. Only the interest can be spent, or other types of bequests can allow you to spend the income, but you still need to quarantine those funds so they don't just get snaffled up with everything else. And then there are capital funds. So funds to buy new stuff, stuff that breaks, or as we talked about, pilot projects and that sort of thing. So we're setting aside money for big projects. There's a second way of looking at it, and this comes from England and the UK. We don't have the equivalent of this in the accounting standards. We're working on some projects trying to encourage the Australian Accounting Standards Boards to allow for some of these different ways of looking at our reserves. So for instance, if you have cash at bank and that includes a bequest, say it's $1 million, that will inflate the apparent reserves you have or cash at bank. But just because there's $1 million there, the bequest means you can't spend it. So there can be an artificial inflation of the amount of cash at bank. And you need to be able to explain that. And the standards don't really provide a great framework for that. You can certainly put it into the notes. But this is called the Statement of Recommended Practice in the UK. And when they talk about income funds, they talk about for two types. So unrestricted funds, the funds that you can use for anything, and restricted funds. So restricted funds are, of course, things like capital, so a bequest, or income, so government grants. And there's already been a note in the chat that we have to be really careful with government grants, that for whatever reason we have to pay it back. So it's important not to spend those up front, or perhaps a range of other examples. So some funds are restricted. They're for a particular purpose. There are controls from external parties over what you can do with those funds. And that's a particular quirk in the non-profit space. But then you have what we're going to spend the rest of our time looking at, which is the unrestricted funds. So these are funds such as cash reserves, or that are designated for a specific purpose. So we can have just general reserves, or we've talked about you might want to prepare for a building fund or a project. These are designated for a specific purpose, and fund accounting, or putting aside funds for particular purposes, is again something really interesting in the third space. So how much reserves do you actually need? And we can think about this like the Goldilocks zone, and there's two references to Goldilocks zone in when you go on the internet and you search. One of them is basically from folklore. So the idea is, three little bears, and the story about Goldilocks and the three bears, and everything was either not too big, not too small, just right. So the idea from a folklore is that sometimes you can have too much reserves, or you can have too little reserves. So what you're searching for is just the right portion or the right size. And in astronomy, if you like, so the folklore is really about external perceptions. So what you're thinking about is what it looks like to other people. There is an issue if you seem to have too much reserves or not enough reserves. So trying to find the right amount there. Astronomy has a different view, and the Goldilocks zone refers to planets. So in a solar system, if you're too close to the sun, your oceans will boil up. If you're too far away, your oceans will freeze. So Earth sits in the Goldilocks zone, the zone where life is optimal within the solar system. And so this is more about internal sustainability. So it's a sweet spot. So trying to find the sweet spot for your organization where you have enough reserves to survive and to thrive. Both of these are about finding the right size for your organization. And we're going to spend some time looking at what the right size might be. So anecdotal segue 3. How much reserves should you have? And this is non-trivial. I was on the board of a charity and I raised the question about reserves because we didn't have any designated reserves. And this wasn't the conversation, but the conversation was kind of close to this. And so the Goldilocks Charity Association, which is meant to be fictitious, was discussing how much operational reserves to hold. And a board member said, well, 3 months is enough. The treasurer said, oh, that's too little. We need at least 2 years operating expenses in order to ensure a going concern and to prepare for contingencies. The fundraising manager says, oh, 2 years is too much. People won't give. I think we've got too much in the bank. And the employee says, well, does that include the building fund or is it something different? So how much reserves do you think? What's this gutterbutt out there about how much reserves you should have, do you think? Feel free to use your mics if you want to, otherwise the chat's good. So Ruth's doing 3 months. Carly's saying 12 months. Oh, g'day, Carly. Sandra's saying 1 year operating costs. 6 months. Yep. Enough to cover bills, so 3 to 6 months. Okay. Operating reserves, very good. We've been told 4 to 12 months. Wish or use a formula made up of various potential liabilities. Ish. Very good. And one of the reasons that we've been working on this, and some papers come off the wall, some papers come because they're driven by industry. This was very much fueled by that early conversation I had with my board, which is how much is enough? And there does seem, as just been demonstrated in the chat, a range of different views about how much reserves is enough. So what we've done in terms of the academic piece is we went and we looked at literature, but then we plowed our way through the ACNC data and we looked at different size charities and we looked at different sectors of the economy. And the general advice is that 3 months rule of thumb, or 25% of your annual expenditure, is what most people suggest is reasonable. But that actually comes from the personal financial literature. And there's very, very little written about Australia and how much reserves charities need. And so Professor Renee Irvin and I, Renee was brought out to Australia under a grant from the Potter Foundation. And we looked at the ACNC data and found that basically organisations actually need different levels of reserves depending upon their size and their sector. So the difference of views that are expressed here could actually just be an expression of your size or the sector that you operate in, because some sectors have more volatile income streams. So for large organizations, and we'll go through some of the data, 3 months is actually pretty close. It's pretty good. But smaller, medium organizations, you actually need more. And the story varies between size and subsector, and it's based upon a whole range of individual contexts. So how do we calculate operational reserves? So the way this is, and there are a number of calculations out there. This is what we looked at. So net current assets. So this is money that you can you can get to quickly. So normally that's within 12 months. So it tends to be cash or cash-like assets minus your net current liabilities divided by your annual expenses times by 12 gives you your operational reserves. So it gets expressed in terms of months. And the reason for that is, rather than a dollar figure, there's such huge variety even within sectors and sizes that calculating by months is a better way of thinking about it, because any organization can say, oh, I need 3 months or whatever it might be. So I do want to note some limitations before I share the main findings, that this is ACNC data. The ACNC data mainly only has charities. They don't currently capture all of the non-profits. If they did, that'd be much larger database, but there's about 76,000 cases in our study. The other difficulty with the ACNC data, when we think about how this is net current unrestricted assets, in other words, assets that you can genuinely use and that don't include your bequests. The problem with the ACNC data is it doesn't differentiate those for us. There's one reason why we want them to differentiate between assets over which the organisation has control and assets over which the organisation actually doesn't have full control. So restricted versus unrestricted, because you can't use bequests. You can't just use government grants for whatever you want. You have to use them for that particular purpose for which they were given. So the following information probably overstates the actual reserves, because the data doesn't go to the granularity that we want it to do. And unfortunately, ACNC at the moment doesn't require small charities, of which the majority in Australia are small. It doesn't provide us with information about small charities' current assets, only total assets. And what we did was we calculated, we looked at 4 years of data, and we matched by Australian company number all the charities, and we looked at the fluctuation of income over a 4-year period. And we looked at that based upon size and by sector. And we basically were trying to look at, well, how much does income fluctuate for small organizations, medium organizations, and large organizations? And it may not surprise you that larger organizations are more stable, and small organizations were far more varied, and also different sectors. And what we did is we created 2 figures. So we looked at, we can certainly calculate average reserves, but we were interested in 2 things in particular, because this is about operational reserves. So how much do you have to have when you're planning for the bad event? And months reserves needed to survive a 1 in 10 year event, and months needed to survive a 1 in 100 year event. I did some work around my property, and I dug a trench because we had some inundation on our property, not flooding apparently, just inundation. And we needed to pull water away. And I had a relative who's an engineer. He came along and said, oh, you've over-engineered that. You've engineered that for the 1 in 100 year event. And I said to him, yeah, well, that event happened last week, so we've got to deal with it. And we don't think about the 1 in 100 year event, apart from 2020 really drove that like a spike through our foreheads, that we have to pay attention and have reserves. Otherwise, we're really going to flounder and be in trouble. But a 1 in 110 year event basically means that there's a 10% chance this year that something's going to happen. So if you think about GFCs, and you think about downturns, and you think about mortgage fluctuations and a whole range of things, about every 10 years, something tends to happen in a market on average. And it can be bad, but it's not seismic. And about once every 100 years, they talk about the black swan event, the cataclysmic event that seems to happen 1 in 100 years. And as we talked about earlier, COVID has certainly done that for us. So these things don't come urgently, but if we're to be prudent and good stewards, we need to prepare for them. And I'm going to share some data, but basically, just for clarification, a small organisation using the ACNC data is anything that's under $250,000 per annum, medium's between $250,000 and $1 million, and large is up to or greater than $1 million. There is talk about changing those, but we'll see what comes out in the next information statements. So this is come from our paper, so Surviving the Black Swan Event, how much reserves should non-profit organisations hold? It's been accepted and currently in press with Non-Profit and Voluntary Sector Quarterly. And it's expressed in terms of months of reserves because it allows for any income. It just calculates that. And unfortunately, you can see small is missing. That's because the ACNC doesn't ask that information from small charities, so they don't give it. But in terms of the spread, medium organisations have between minus 436 months span. So this is calculated, remember, net assets minus net liabilities divided by expenses. An average of about 40 months and a maximum of 40,000 months. And large organisations are similar and 35,000 months. So if you're thinking about giving to a charity and it had 35,000 months of reserves, would you give to it? Do you think they need reserves? Do you think they need donations if they've got that much reserve sitting there? Yeah, so this becomes the importance of explaining in your financial statements why you have such a big, yeah, in fact, you're exactly right, that they could be bequests. They could be just because they're sitting there doesn't mean you could use them, but we need to be able to communicate this with our stakeholders. If they simply look at cash at bank or they look at net assets, it's the wrong message. We need to think about other types of communication. And so this becomes the challenge is we need to engage in stakeholders and explain to them, if we have that sort of reserves, why they're there. And this is just operational reserve. We're not yet talking about other types of reserves. So this is just looking at income. It's calculated based upon fluctuation of income using Z-scores, and then basically, well, how much reserves do you need to accommodate that fluctuation? So the 1 in 110-year event for small organisations, you need 6 months is the average, and the 1 in 100-year event, you need basically 11.1 months is what statistics are telling us. So small organisations simply are more volatile, and if you're trying to protect yourself from unanticipated events, you need to have reserves around about 6 months up to 11 months if you're a small organisation. Medium firms, it's 3 months for the 1 in 10-year event up to 5.5, so call it 6 months if you're a medium-sized organisation. And large charities tend to have a more stable income stream, but certainly you need to have at least 3 months. And in absolute terms, of course, 3 months for large organisations are bigger. So overall, the average is actually more than that. But whenever I tried to do box and whisker plots to show it, and it's completely distorted. There's enormous variation across the sector. And if you notice here, does that worry anybody that some organisations have got minus 436 months reserve? Should that worry us? Yeah, now, again, the challenge might be that this is at a point of time that they've reported this, and it may be that there's a new grant coming in and it just looks bad at that particular point of time. But the issue here is around the going concern. That we have to ask questions about we need to be able to meet our debts as and when they fall due, and that's not looking good, because this, again, remember, this is calculated off current assets, not your non-current assets. Rakesh, you're absolutely right. So again, the challenge with the financial reports is they're often your assets are a cut in time, and it may be next week the grant's coming in and it's all fine. And again, you'd have to go into the financial notes to get at that. But the point is, we're trying to encourage people to think about reserves, and given the year we've just had, encourage them to think about, well, how much do you need? So small organisations 6 to, you might as well call it 12 months. Medium organisations 3 to 6 months, and large organisations 1.5 to 3 months is the rule of thumb. But there's huge variation based upon sectors. So arts is very, very far more widely dispersed in ranges. There's far more variation and fluctuation in income. If you're, say, in schools or aged care, they're far more stable patterns of income. So it does depend a little bit upon sector. In terms of what a reserves policy should include, and this is based upon those two sources, the ACNC site and the charity reserves, financial stability, and also looking at the ATO. In a reserves policy, this should be really in there with your financials, and it's talking about why you have reserves. And we've given some explanation about why, but within your organisation, you need to express that about why you have the reserves you have. You need to specify the different types of reserves that you have, whether they're reserves that have got conditions placed upon them from outside groups, so bequests or government grants, or whether you have determined you're setting aside money for projects, capital funds, investments, staff leave, and so on. So what levels you aim to have, who sets the reserves, and why you set it on that figure. So hopefully some of the data, and particularly when this paper is published, they'll give some clarity around that. Your strategy for increasing your reserves, so how are you actually going to get there? It's easy to say, oh, you need 12 months if we're small. That's very hard. I've run small organizations. So how are you going to get there? How do you build a buffer in? And I know if I ran a charity again, I would create more surplus in all my projects. I'd actually start building towards that in the long term. Who can set the levels and use of reserves in your organisation? So is that the board? Is it delegated? Will the spending of reserves? How will the spending of the reserves be determined? Accountability for reserves, who, to whom, and what? How will reserves be identified in budgets and financial reports? How will stakeholders be alerted to the reasons for reserves, which we've talked about in the chat? How will the reserves be invested? How will you protect capital, particularly if it's bequests? And how and to make sure that you include these some of these in notes or as attachments or on your website or somewhere. So there's some things that probably should be in a reserves policy. And other advice, and this is from EGRI, talking about too little too much. Each fund also should have some records attached to it. So what's the fund for? So to replace IT systems or staff wages, or it's a bequest, what the budget is, how this project will enable the organisation to fulfil its objectives. So remember back with the ATO, they said you can have a reserve provided you can prove that this is being used to meet the objectives of the organisation. So you need to have something in writing that explains that. And also how this project complies with the governing rules. So you can point back to your governing document, your constitution, your incorporation documents, and say, well, under section we're able to trade or to invest or to keep money. So you refer back to the section. So you're covering yourself off on all of the required rules in case anyone comes knocking or asking. And just in terms of some suggested funds, you obviously want an operational reserve. So that's what we've talked about in terms of the small organizations 6 to 12, medium 3 to 6, small, large organizations 1.5 to 3. You want staff allowance fund. So looking at long service leave and that sort of thing. A rapid response fund. So being able to pivot in response to needs, equipment replacement funds, and also to quarantine specific funds. So bequests, some contracts, and public appeals. So a whole set of resources that we can make available for you afterwards. But I wanted to finish up there and thank you very much for your time, and happy to take any questions.
So thank you, Craig. That felt just right, may I say. So I can see that there's no questions coming up yet in the chat room, but people should feel welcome to unmute and ask their questions of Craig. So Ruth is coming up with a question there. Who normally advises a not-for-profit on these matters, Craig?
Well, often financial advisors or accountants would do this. Treasurers would also have views. There's just been a lack of data. And so one of the advantages of the ACNC is that it gives us data for the first time about the whole sector. But when you're looking at, if you're trying to estimate how much money you need based upon fluctuation, you needed time. So we've just now got 4 or 5 years data from the ACNC. So we've been able to calculate and work this out. So the long answer to your short question is, there's a lot of people giving advice, but there's not a lot of evidence to inform that advice. So part of what we're trying to do is to develop evidence that help people make informed decisions.
So Rakesh has got a question there. Do we take a different tack if we are funded? Rakesh, you may need to expand on that a little bit. Craig, do you want to have a tackle of that?
Yeah, so what do you mean by funded? Do you mean funded by government? Funded by another charity? I'm not sure what you mean. By government. Yeah, so one of the challenges is you have to go and have a look at your contracts, but often the government contracts come with conditions attached that if you don't deliver the outcomes, so one way to think about government funding is it used to be just a grant. It used to be go forth and be good, we love you, but now it's more around a contract, and it's a payment for outcomes, that you will deliver these outcomes and we will pay you. So if you don't deliver the outcomes, government may not pay you. Even if they've given you the money up front, they might ask for it back. So the general advice is that when you, and this was, I think Yvette talked about this earlier, that when you get income from government, particularly if they have these clauses, you need to also create a liability. So effectively you've got net assets, because the income's there, but if you have to give it back, what you do is you slowly draw down upon that so it balances out. And you really should quarantine that money, because if you spend it and you have to give it back, then you're in trouble. So yes, it would be a type of reserve because it has conditions from government. So I would regard it as a type of restricted fund.
So there's some points coming up there, Craig, that you can see on the.
Yep. I don't know if their views are diverse. And Jill's saying it's not just government, but other donors. Absolutely correct. So if, the bushfire appeal is a classic example of where money was given and it wasn't used for the purpose that people thought it was going to be used for, and there's huge backlash and anguish and angst about that. So generally when we go and do appeals, we're saying we're going to use it for this purpose. So what we should be doing is quarantining that money and using it for that purpose. So during the tsunami, some charities in Indonesia, some charities just kept taking money even though they knew they could never possibly spend it. And that really hurt them in terms of their reputation. Médecins Sans Frontières basically closed its online portal for giving and said, we can't spend your money. And it wrote back to donors and it said to them, what would you like us to do? Would you like your money back? Would you let us use this for another purpose, or would you allow us to use it for whatever purpose we like? So in so doing, if people, and most people came back and said, oh yes, we trust you, just use it for whatever. So suddenly that became unrestricted. They could just use it for whatever they wanted to do. But the appeal for Arche, they had to use that money for Arche. So this is an ongoing issue for charities, and it really involves your reputation. And so being clear with your donors. If you say, give us money for this purpose, you really need to use it for that purpose.
Craig, can I ask about the comparisons with the for-profit sector? You know, the small to medium enterprises in the for-profit sector. How is it different?
Well, the issue is, just say you've got a family business, you're really accountable only to yourselves. And so it's wise to be prudent, and it's wise to be, but as long as if you're complying with tax law, no one's looking over your shoulder and saying, what are you doing with the money? The challenge for charities is because of government, because of bequests, there is a need to make sure that you're operating well and cleanly. A going concern applies to every organisation, but there are just additional restrictions, and particularly a bequest is a really unusual entity and very, very hard to contradict the will of somebody who's died. There's a whole legal process called SOPRE to get around that, and generally it doesn't, well, mixed results, but often doesn't work. Charities have gone to try and overturn the will of somebody, and it often doesn't work. So yes, many of the things I've talked about, so rainy day accounts, saving for funds, all of those work, but some of your restricted assets really, I can only think of that working particularly for charities, unless you've got a large contract with government, but you won't have the restrictions perhaps that the charities have. Again, it'll depend upon the nature of the contract. If it's asking a question about risk appetite, yeah, so look, some boards are bullish And I've experienced a bullish board. I've experienced the negative consequences of a bullish board spending more than basically overspending and having to shelve staff. I've experienced the consequences of that personally, but other organizations are so conservative, they're just staking it flat for no really good reason. So this is why I've tried to frame it up is, can you go back to your mission and think about why do you have this? And so this balance between being prudent and being a good student, a good steward, and not and actually using the money for purpose. So it's this balance between stewardship and being able to justify where you're stacking it flat. Because there are some charities that simply, as my grandmother would say, stack it flat. They just keep putting aside money and they can't really justify why it's there, apart from, because some of those are enormous. I mean, 40,000 months. That's an enormous reserve, and I can only think there must be quite large bequests sitting in there. But you're right, the risk appetite will come down to how the board responds. But again, the questions I provided, what is your policy? Why do you have it? Who controls it? Those are things to work through at a board level, and the answers will be slightly different, as you suggest, depending on how bullish or conservative your board is. But again, this balance between financial stewardship, but also ensuring that you comply with taxation rulings, that you use your money for your mission.
So I'll just call for any last questions. So Rakesh is saying, so who is responsible for the decision-making regards reserves?
My view is it really sits with the board. The board should be the ones making these decisions. They are the accountable entity. So in terms of who signs off on your financial report at the end of the year, that is your board. It's not your treasurer. It's not the auditor. It's actually your board. So the board needs to also explain in that report what has been done with the money and why, and also why it's been done. So the responsible entity really is the board, and that's why I've suggested you have a policy and you work through those steps with your board, looking at, but the board can delegate. They can choose to delegate, but in the end, it all comes back to the board. But you have to work through those steps and asking the question, well, the board is ultimately responsible, but are you going to delegate that to a treasurer? And possibly will have a little bit to do, or you might have a subcommittee. So there can be a risk subcommittee, there could be risk and reserves, because in many ways, reserves mitigate risk.
Craig, thank you. And I thank everybody for your involvement today. I think it's a tremendously important topic. I've been with donors who have talked about other organisations and described them as bloated because they have a certain level of reserves. And that how much is enough is a very vital question, I think, for the donor community, for fundraisers, for boards, and just for our organisations to function with integrity. And your guidance is very important. I think particularly during times like COVID, we've seen the organisations that have who do have reserves be able to survive. You mentioned the arts sector, and the arts sector had a very large endowment funding campaign that the government supported some years ago. And I know that some of the major arts organisations are alive today, despite downturn and shutdown, because of those reserves. So it's such an interesting and intricate topic. And I would like to thank you, Craig, and I would like to thank Renee, your Professor Renee Irvin, and also the Ian Potter Foundation for the ability to have Renee here and unpacking the ACNC data in a way that it had never been unpacked before. So congratulations and thank you all for attending today.
Thank you, everyone.
Thanks, Craig.
Okay, bye-bye.